Hey everyone, thank you so much for joining us today. My name is Ashley Stanhope. I'm the Director of Communications for Ether Capital. I'm joined by our CEO, Brian Mosoff, and President and CFO, Ian McPherson. Just for some background, we wanted to host this webinar today just so you could learn a bit more about Ether Capital, our vision, and how we plan to build our business. We'll also explain how we differentiate from crypto, ETFs, and other products out there. And we'll just run a quick disclaimer, just going through a couple housekeeping items before we get started. So first and foremost, this presentation is just for informational purposes only, and we're not here to provide any type of investment advice. Brian's going to spend about the first 20 minutes going through the PowerPoint presentation, and then Ian and Brian will spend the last probably 20-25 minutes answering questions. So if you have any questions, please do put them in the Q&A chat box at the bottom, and we'll try to get to as many as possible. If we don't happen to get to them in this presentation, feel free to email info@ethcap.co, and we will answer them as soon as possible. And the last point I'll make is we're also recording this presentation to post on our brand new website that we highly recommend you check out. But it'll be helpful just in case you need to go over anything or double back and play it again. And with that, I'm going to hand things over to Brian to get us started.
Thanks, Ashley, and hi, everyone. Thank you for joining us today. You know, we actually haven't done a group webinar in, I don't even know if we've ever done it. So it's exciting to start doing this, today, and we hope to do these on a regular occurrence. We have a lot of exciting updates. Some people on the line, names I recognize and we've spoken to individually, but this is a chance for everyone to kind of get up to speed on what we're up to as a company. There's been some exciting developments in the last number of months, and so we're excited to share those with you today and talk about why we're still very bullish on Ethereum, why we're bullish on crypto, despite what's happening across broader markets. And of course, it's easy to get focused in on the price, but we have a long-term view of the asset class. We eat, sleep, and breathe this stuff, so thank you everyone for joining. We've broken up this presentation into 4 sections. Ian's already advanced the slide for me, but we've broken this presentation into 4 different sections. We're going to talk about some of the recent developments that have happened at Ether Capital, and then Ian is going to talk about our recent financial results. Then I'm going to go into some of the industry developments surrounding the Ethereum ecosystem and the wider crypto or digital asset industry. And then we're going to talk about why Ether Capital specifically, as an access point in the capital markets. So we'll start with section 1. So some recent developments, what has been happening at Ether Capital. We have new management on board. We have an announcement about a pending acquisition from one of our portfolio assets, Wyre. We've increased our staking position over the last number of months, and then now we are focused on strategic growth opportunities, which we'll talk about momentarily. So let's first talk about the additional management. Many of you may have already met me. I've been around since mid-2018. Recently, we were joined by Ian McPherson and Jillian Friedman. Ian comes from many years in the traditional banking industry focused on M&A, and he is our new CFO and president. Jill Friedman was at National Bank, is a lawyer, and is joined as our chief operating officer. And kind of around fall of last year, Cheyenne Eskandari joined as our CTO, one of the leading minds in the space doing smart contract auditing, very deep thinker on what's appropriate in terms of custody and staking design. So very strong technical thought leadership. So why did we bring this management team here? Well, historically, we've been seen as a passive holder of ETH. That's how this company was put together. It was the very first thing we did. We built a big position in Ethereum back in April of 2018, but we didn't want to just be an access point for exposure to Ether. We always wanted to do more. We always wanted to build infrastructure, and we also knew that staking, the ability to generate yield off our Ether, would one day come about. And so this team, this point 2 says that we're bringing additional depth and experience to look for opportunities for Ether Capital that we can leverage the knowledge of the crypto natives on our management team, and not just the board. Many of you may be familiar with some of our board members, but now it's actually day-to-day full-time employees on our management team to assess the space and decide how are we uniquely positioned to build interesting infrastructure. So we plan to utilize the experience and expertise, both understanding the digital asset ecosystem and traditional finance. And one of the things that we actually talk about, Ian and myself and Jill and Cheyenne, is that right now in the industry, there's kind of this spectrum where we find a lot of businesses sit on either the artisanal, crypto native, they understand that space. And then on the other side of the spectrum, you've got people from traditional finance or institutions with strong reputation, but don't really understand the industry. And so as we look to new businesses, we want to play in that middle ground and bridge these two worlds. And that's why we have this nice blend on our management team. So we're very excited for our new set of executives. I'm not going to say too much about the Wyre transaction. It's pretty much all on the slide. We held a minority position back in 2019. We made an investment in this company called Wyre. And recently there was an announcement that they are being acquired by Bolt, who is a private US company. Ian, is there anything specific you wanted to touch on this slide?
No, I think that's good. Hopefully we'll have more information to share in a few months.
Okay. And then of course, many of you may know that we are very excited about staking. Staking is relatively new for the Ethereum ecosystem. It offers this unique opportunity to generate yield by holding Ether and replace proof of work mining as a method of validating transactions. Many people are familiar with the term mining. This is people spending electricity and computing hardware to validate transactions and create blocks. And Ethereum is transitioning to a new method of validation called staking, which the third point here says is a voluntary action by people who are ETH holders to decide if they want to just continue holding their ETH, or they can lock up their asset and generate a yield while helping secure the blockchain. And while they are doing that, they are receiving a reward. And as they are proposing new blocks and helping validate this blockchain, they're generating yield on that Ether. And that's something that we've always been excited about at Ether Capital. So here's an overview of currently what we are staking. Ian will get into it a little bit more in the financials, but essentially we're staking 50% of our Ether balance. Some people may wonder, why aren't we doing all of the Ether or 75% of the Ether? And we're going to get into this event called the merge momentarily, but it's important to recognize that the upgrade from proof of work to proof of stake is rolled out in a number of stages, and it's still a very, very new activity, and there's still a lot of technical things that are being worked out. And so we are slowly building our position. Where we'll get to in the long term, I would hope to see us be staking a majority of our ETH balance, but at this point in time, we are staking 50% of the Ether on our books, and currently the yield is approximately 4.3%, which is written there at the bottom. So I'm going to turn it over to Ian now to talk about the financials.
Thank you, Brian. And a few weeks ago, we published our Q1 results from March 31st, and that seems a long time ago, but this is a snapshot of the financial highlights. And the one number that I want to draw everyone's attention to is in bold on the right side, net operating margin, $407,000. So in Q1, we made our first operating profit. And I think this is interesting compared to some of the other investment opportunities, and we hope that will grow. It's primarily because we now have revenue that we historically had not had before. So what is that revenue? Sort of outline it here. We have two sources. One is from a consulting agreement we have with a related party called Purpose Investments. They have a family of crypto ETFs. We participate in the management fee of that from supporting the launch of those ETFs, and our Q1 revenue was significant. Compared to the other sources, staking rewards and staking Ether, which also is strong. We have 20,735 ETH And as Brian mentioned, we're yielding 4.3%. So what would be some of the insights to those financials that I've just shared? Firstly is, unlike an ETF, as all of you know, that has a management expense ratio that is a drag on the portfolio, we're actually accretive through our revenue versus operating expenses. Secondly, there's no plan to pay a dividend. We're going to reinvest the money in building businesses and making sure that we have a strong cash reserve to fund our operational expansion, of course, with approval of the board. So a quick snapshot of our assets. Historically, we've been a business that investors have looked at as for that basis. Brian's going to talk about how we're going to sort of shift that perspective. But as of March 31, we have sort of 4 categories of assets listed there. The accounting valuation was $192 million for those 4 assets. The one thing I would like to sort of mention, though, of course, since March 31, the Ether price at that time was $3,284 US. It is down significantly, about 35%. And so from a book value basis, you can probably anticipate that our value of assets is much lower than that on a mark-to-market basis. What is the split of how they are allocated? Ether has about half our assets. Staked Ether, which Brian talked about, is about 43%. And we have cash and investments about 6.6, which gives us liquidity. One of the final comments I'll make is how the share price performance has been over the last 3 years. You can see we were very low and flat at the start of this period. We've peaked early at the start of the year, and then we've had decline, and that's because we're highly correlated to the price of Ether, which has been volatile, and Brian will address a little bit later on. But one of the interesting insights, you see a box up there, and this gets back to, I'll call it the Benjamin Graham, Warren Buffett view of what is the margin of safety. Right now, our shares are trading May 31st at about $79 million. It's the value of the shares. But if you looked at the theoretical value of our underlying assets, they were closer to $120 million. And so the shares are trading at about a 34% discount. And we'll address that a little bit later on of why this is an interesting opportunity. But for those that are interested to invest and purchase on the open market, this is a huge margin of safety for you versus the underlying asset value. So with that, I'm going to turn it over to Brian for the interesting stuff.
So we're going to talk for a few moments about some industry developments. This slide talks about the Ethereum merge and what that specifically is. So I mentioned earlier that Ethereum 2.0, the new network for Ethereum, rolls out in a number of different stages. Currently, we're in the one called Phase 0. And Phase 0 basically is just a very wireframe basic version of this new network. What's coming up is the launch of Phase 1. And there's an event coming up in the next few months, could get delayed, but the next few months we expect there to be this event called the merge. And the merge is where all of the current Ethereum activity that's taking place on Ethereum 1.0 merges together with this new network, Ethereum 2.0, and all of that activity, all those transaction fees, DeFi, Metaverse, all of those verticals will take place on this new network. And they will turn off proof of work mining, get rid of all that hardware and electricity need, and replace it with staking as the method of validation. This, we believe, is going to be one of the most important events in all of crypto for this year. We've been waiting for it for a very long time, and it's very exciting. And we think it is also very underappreciated by a number of investors, even within the crypto industry, on why this is potentially a really big catalyst for Ether. So we've put a few slides together here. We've talked about that second point. Wait, go back. We talked about that second point about turning off proof of work and turning on proof of stake. This third point we think is really important to kind of help people understand that currently the amount of Ether in existence, the circulating supply, about 10% of that Ether has already moved on to this new network. And when we look at comparable networks, comparable staking networks, Polkadot and Solana. There's a website called stakingrewards.com. We see that this is an extremely low percentage of circulating supply to be locked up. And so it's possible that when the merge happens and people would be able to have their staked Ether be freely tradable, where they could stake it, they could unstake it, that a large percentage of the network would get locked up. And so that's really exciting because the circulating supply could drastically change here. The last point here is, as we've spoken to a number of institutions and family offices with ESG mandates, there's certainly concern around the Bitcoin proof of work mining narrative. Ethereum currently shares it because it does use proof of work for validation. And so this new network will be 99.9%, roughly percent more energy efficient. And we think that this is a catalyst for those institutions that have sat on the sidelines to start building a position in a portfolio because it lines up with internal ESG mandates. So that's very exciting. On the next slide, we've talked already about that many ETH holders have elected not to stake yet because they weren't sure when this merge event was going to take place. The original phase 0 Ethereum 2.0 network went live December of 2020 with an unknown date for the launch of phase 1. So it's taken about a year and a half to roll out this next phase. And so a lot of people have sat on the sidelines, as I mentioned, waiting for this point in time. So they're very excited. Post-merge, we think that there will be less circulating supply, which we've already talked about. And some people will say, well, that means that there would be a lower percentage in terms of yield on your staked assets because you're now sharing the newly minted ETH rewards and transaction fees with a greater number of participants. And that's true. But it also means that as the circulating supply dries up, there's potentially strong upward pressure on the price of Ether. So it's still a reason to be bullish. We don't know what will happen, but those are two things to think about that we're constantly helping investors think about as they're considering what will happen in a post-merge ETH1 and ETH2 world. We continue to believe that Ethereum will continue to be dominant. It is the second biggest asset by market cap, which you'll see on a slide in a moment. And this moment will also prove that the Ethereum community and development teams are able to address a lot of the technical deficiencies that people complain about with the network. We're starting to see different ways emerge for Ethereum to scale, to have more throughput and lower transaction fees. And so this is a very exciting moment in time. Currently, the expectation is that the merge will take place by the end of summer. Again, it could get delayed a little bit, but right now the expectation is that this event will occur in August. Next slide. So some other things that we're seeing just today, we're seeing a bill come out of the US with a proposed new set of regulation. We are often asked questions, like, will governments just ban crypto? And our answer is no. Governments in the US and Canada are working with members of the industry to come up with thoughtful policy and make sure that the asset class is used appropriately and interacted with in appropriate ways and snaps into existing guidelines. And maybe some new guidelines need to emerge. We are part of the formation of this Web3 Council in Canada that was announced back in March of 2022. And it's meant to be an organization to basically be a beacon for education and an access point for anyone who's a policymaker, who's in government that wants to just understand this space. So this is something that's ongoing. I don't think it's going to end anytime soon, but it's something we are actively engaged in, and we think gives us, Ether Capital, unique insight into what the industry is going to look like and what infrastructure is going to be needed down the line. Recent crypto price declines. One thing, if there's some silver lining here, I was asked this recently on a Bloomberg interview, is that in the last couple of years, in that second half of 2020, when we saw a big explosion in interest and people curious about the space and new verticals emerge, like NFTs and the metaverse, and DeFi was already around at that point, but there was a lot of noise. And I think that with the price decline, people are going to refocus their portfolios. And instead of looking for the next flavor of the month, they will draw their attention back to blue chip assets. And that is Bitcoin, in Ether and the ability to generate yield off those assets, whether it's through lending or for someone like Ether Capital, staking. And so we think that this is going to declutter a lot of the noise in the space. And we also think that people are going to look at competing blockchains, and instead of saying, well, let's speculate on the next thing, the next Bitcoin or the next Ether, maybe they're going to take a step back and say, was there really meaningful development here and meaningful infrastructure? Can it actually compete with Ethereum? So this is actually a bullish moment, I think, for Ethereum and people who are focused on infrastructure surrounding that, that ecosystem. And so that's one silver lining here. And there's an opportunity here to, as we get clarity on regulation, decide what is the opportunity here for, you know, building out meaningful infrastructure for the next leg in the space. I think one thing that was very clear in this bull run is that the asset class didn't go away in that early crash of 2020. The space didn't go to zero. There was a huge drop of about 40 to 50% overnight around the OPEC crisis. And I think regulators, governments, retail investors, institutional investors that were kind of sitting on the sidelines at that point weren't sure in that last bear market if the industry would survive. And it proved that it did. And so I think people are getting more comfortable with the asset class. And so the question really becomes, what infrastructure is going to need to be built for this next leg up in the space? As we get into whenever that bull run will be, I don't know if it's 6 months out, 2 years out, 5 years out, I don't know. But what infrastructure is going to need to be there? Is it around custody? Is it around staking providers? Is it around reporting obligations? You know, what is it going to mean to build institutional products and bring those to market? So that's something that we are very excited about. Next slide. We just put this together to help people understand, you know, how big Bitcoin and Ether are relative to some of the competitors. We see headlines often around Cardano and Solana being ETH killers, and this just shows by market cap, you know, how much bigger Ethereum is than its competitors, and also how much bigger Bitcoin is currently, and the possibility for Ethereum to really kind of price itself up. If you think about these two assets and where the attention falls, most of it first falls into Bitcoin. It's the biggest by brand, it's the biggest by market cap, it's the oldest blockchain in existence, and it's an important asset. We're not against Bitcoin by any means, but when we look at all of the exciting activity that's taking place, all of these verticals and narratives around DeFi and stablecoins, that activity does not happen on Bitcoin, it's all happening on Ethereum. Yet the asset currently has a substantially smaller market cap. So on the next slide, Ian, yep. I'm not going to say too much about the price chart. I wanted to go to the transaction fees. When we think about how much people are using Ethereum, this is two references here. One on the left is a website that we've taken a still from called cryptofees.info, and it shows the daily transaction fees being paid to use various blockchains and certain applications on those blockchains. So you see at the top, Ethereum in a 24-hour period collected, you know, just over $10 million of fees, Bitcoin 500,000. And this is a website I check probably once a week or whenever we have an investor presentation. But it's clear that every single day, doesn't matter if you do this in 2 weeks, 6 months ago, Ethereum dominates this chart. And also interesting to note is that all the things that are highlighted in kind of a pinky purple are applications that run on top of Ethereum. And so this again just kind of helps show people how much people are using Ethereum for all of this activity. And there's a great visualization that our CTO pointed out to us a number of months ago that we're going to pull up here. Ian really likes this. And what this does is in real time show various applications and wallets and where transactions are coming from and showing them being put into blocks. So my internet connection may be a little chunky or it's Ian, so we don't see it quite moving in a smooth way. But all these little people are individual transactions that are taking place on the network in real time. They're waiting in something called the mempool, and they're waiting to be included in a block. And you can see a bunch of people just got in the bus, and those buses are basically blocks. And those are confirmed transactions that are now official on a blockchain. So it's a very cool visualization of just how many people are using this network and where some of the transaction fees are coming from. And that's important because, again, a portion of those transaction fees, which are currently going to proof of work miners, will be going to proof of stake validators, a portion of them, post merge. And so what that yield will be when we start thinking about how do we know if it's going to go up, if it's going to go down, we don't know. But just a reminder that not only are you getting this kind of fixed base fee per block in terms of reward, you're also getting a portion of the transaction fees. So when you look at this chart on the left, the more usage there is on this network, the better it is to be a validator. Next slide. So I'm going to turn it over to Ian to talk about our strategic positioning and kind of what separates us from other closed funds or ETFs in the market.
Yeah, thanks, Brian. And all of you on the call have choices of how you would like to participate in the growth of crypto. As Brian mentioned, the sector is really dominated by a lot of private small companies. There's very few publicly listed choices. And so what we're going to do is talk about how we compare to those choices that you have. Now, the first thing is about 93% of our assets essentially are Ether or Ether-based, and our share price is going to be highly correlated to the success of Ether. Secondly, what's different about us is that we aren't just passive holders. We can now generate a yield like a dividend or interest on our Ether, which is a fairly new and recent phenomena and not available to a lot of the public investments. I'm going to talk about why we're a better value proposition than ETFs. But going forward, I think one of the things that we will want to do, and it will take time, we'll earn that trust in you, is that we are going to seek to generate operating earnings and reposition the company from a net asset value basis to a multiple of earnings basis. And that will take some time. We've been working on developing those businesses. They will take time to be approved by our board. We will disclose them. We're not quite ready yet. And of course, it will take time to implement. But that is where I think we play to our strengths the most and will differentiate ourselves from some of the alternatives that you have. And why, and we'll explain why we think we can be successful at that. Now, here's, I'm hoping, an informative and interesting slide that compares ETFs to Ether Capital. And there's sort of four things that we would like to highlight. And people, not that ETFs aren't a good investment, far from it, but we think that there's something unique about ourselves. Firstly, if you went to an Ether ETF, about 100% of the assets are Ether. We're about 93%. We're highly correlated. It's not materially different. Secondly, most ETFs trade very close to the net asset value. We're trading at a discount, and currently it's going to be in the 35% range, which I talked about earlier. So we're essentially getting Ether on sale at 35% off. Thirdly, we are able to generate yield that can't be earned on an ETF. And so we have upside there. And finally, as I mentioned earlier, we're going to try and generate operating earnings that will supplement our holding of Ether and the price appreciation. You can't do that in an ETF. You only are a passive holder waiting for the price of Ether to go up. So with that, I'm going to turn it over to Brian to close before Q&A.
Yeah, and to recap basically that last slide, it's very concise. As I mentioned earlier, when this company was put together, it was always meant to build infrastructure. That's what Sam wanted to do. That's why I came to this company. We believed that there was more to do than just hold ETH. And we're still very excited about Ether, but we're also really excited about how the industry is evolving and what we believe the opportunity is for a company like ours and the skill set amongst our management team and our board members to help develop the industry. So it's something we're really excited about. It's something that we were slow to move on, partially because we always wanted to use that ETH balance to generate this source of revenue for us, a meaningful source of revenue, and then use a portion of that revenue to go and build the businesses. And as I said earlier, staking has been slow to roll out in different phases. And so the more we are able to stake meaningful portions of that ETH, the more revenue we have to invest in businesses and in talent. So this is a really exciting time for us. I'm excited about the new management team. I'm joined by 3 new faces that you saw on a slide a number of pages ago, and that's really exciting to me. And again, it's exciting to say, let's build a big company here, not just be a pseudo ETF. So with that, I'm going to go to Q&A. There's a number of questions that have come in here, a lot of them relating around the financials. I don't know, Ian, if you can read the Q&A or if you want me to read the questions and then you answer. But if anyone also wants to ask a question, please type it in the chat box or the Q&A box. And we've got about 15 minutes here to go through them. You're on mute, Ian.
Could you read them so I don't pollute the screen with my chat box?
That also means you can't filter if there's anything you don't like. But
no,
no
this
problem.
is dangerous.
So the first question here: do you anticipate any tax liability on the sale of Maker, or have enough capital losses being incurred to cover the gain on the sale? So for those who don't know, we held a small position in a token called Maker. The token symbol was MKR, and we've divested that position back into Ether. So that's what this question is about. Ian?
At this point, we think we have sufficient tax loss carry forwards to be finalized, but we think we're okay.
Okay, next question. Has the staking rewards recorded as revenue being converted to fiat or remain in the form of ETH? If it remains in ETH, then revenues are overstated given the decline in the price of ETH. Staking rewards were they 4,000 reported as income? How are we basically thinking about staking rewards, and how are we accounting for them on the books?
Yeah, so very interesting question, and I hope that I don't jump too fast for those that aren't familiar with the issue. The staking rewards are in Ether, which is sort of staked Ether. It is illiquid. It is not in fiat. We don't have the ability to monetize it into Canadian or US dollars. The revenue for accounting purposes is measured each day. So it's not a case of it's overvalued. It is what it is in each day, but our asset has declined in value. So there's a subtlety. So the revenue is what it is, but their asset is lower. Just if we applied a prevailing current Ether price, we probably won't have liquidity to sell those staked Ether until after the merge. But no policy has been set yet internally as to if we want to hold it or sell a portion.
So the next question here talks about what we're thinking about regarding a U.S. listing. For some color on that, historically it's something we've a little bit pushed aside because there were issues back in 2018 and 2019 around what the SEC would allow a company listed in the U.S. to do. So Ian, we've had a number of high-level discussions about, is this something we would pursue? How are you thinking about it today? I'm turning into the interviewer here, but yes. I'll let you answer this one.
Well, we certainly see the merits of expanding our listing capability in the United States and having a listing there because it would attract investors there, and there's a deeper pool of investors. As for timing, it's not imminent because we have to make sure our reporting is lined up. And I think it would be better if we have news to share and can increase our market capitalization. I think that will generate better receptivity. And so we do hope that there will be a few newsworthy events this year if we're able to explain what happens to Wyre and how we can monetize that. And secondly, disclosing our strategy. And so there'll be natural times to maybe put a listing, but we certainly see the merits.
Another question here.
Brian? You can comment too. You can comment too.
No, I mean, I think that's accurate. It's something we're interested in, and it's on our list of things to discuss. And that's kind of as much as we can say at this point in time. Someone's wondering, as we expand our leadership team and make new hires, Ian, how are you thinking about stock-based compensation and resulting or potential share dilution?
Firstly, we do have a share option plan, and it does have caps on it. It's a very standard plan, maximum of 10% of the outstanding capital in order to minimize dilution. And this is a very standard plan versus other companies. We certainly see the merits of share-based compensation to executives and new employees, and we still have lots of capacity to include that in the total compensation plan for employees. I think this sector lends itself to that dynamic of less salary and fixed costs and more alignment and participation in the share price and success.
Another question is coming here asking, are we considering investments into private companies in the space? It's something that we were looking at in our early days, but right now we're really focused on transitioning to being an operating business rather than an asset manager, and not being so much of a venture company or VC wrapped in a public structure. So we're not against making strategic investments if we thought it might one day lead to an acquisition or potential an acqui-hire if we like the talent. But currently our efforts are focused on using our revenues to build in-house operating businesses. And we have some ideas about what those will be. And that was another question actually that someone had. So I'll just kind of jump into that. Someone asked, can you give us examples of the types of operating verticals that we are planning on entering? So at this point, Ian had this slide up that said we're not disclosing exactly our plans at the moment. There are things that we are in discussion with the board and hope to announce and share with everyone soon. But I can give people some ideas in that we're not looking to speculate on new verticals. Right? We want to play at that core infrastructure base layer of Ethereum. And so when we think about things like the metaverse and NFTs, those, even though we may be excited personally about those areas of blockchain development, they're not things we're looking to build infrastructure around. So we're not going to build an NFT block explorer or transaction explorer. We're not looking to build our own metaverse. We're looking to ask the question, what do we believe to be true about Ethereum as it scales and becomes more secure and transitions to proof of stake? What infrastructure is going to need to be built? We sat around a couple of weeks ago, the management team, and thought, in 2025 or in 2030, will banks be participating in the ecosystem? What might that look like? Would it be custody? Would it be staking? Would it be offering access to certain assets to their clients direct? We want to build for that world. We want to help facilitate and expedite that becoming a reality. So it's a bit of a vague answer, but I think it points you in the direction of where we want to play. So thank you guys both for those questions. Someone asked, how are we thinking about staking risks? So and specifically reducing the risk of an event like slashing. So this is a little bit in the weeds, and the person who asked that question, if you would like to set up an additional call, happy to chat through it with you. For anyone who's not as in the weeds on what staking is, again, we're locking up our Ether. We are running something called validators. They're run in these 32 ETH chunks, and it can be run on hardware, it could be run in the cloud. We have partnered with a leading staking provider, a company called Figment, I think which we disclosed when we first deployed, I guess the first 10,000 ETH onto ETH2. And Figment has a number of tools that they use to monitor and make sure that they have as much uptime as humanly possible. And this question asks about something called slashing. And what slashing is basically if you proposed a block incorrectly, or if you tried to do something malicious, you would lose a portion of your Ether. And so Figment is one of the leading providers. As far as we know, they have never been slashed to date. They run a number of complex tools to ensure that they have competitive uptimes. And we are in constant discussion with them through a Slack channel that's constantly pinging that I have to hit the mute button on, and also regular phone calls to ask them questions like how they're running their software, how they're thinking about updating their software, so that we're on top and they are on top of new developments in the space. So there's certainly a risk around staking. As we've said earlier, it's a new activity. It's a really exciting activity. It doesn't come with no risk, but it's one we believe is appropriate to take. And again, this is why we've only staked 50% of the Ether instead of 100%. But we believe that our staking validators and partners are appropriate and industry standard for us to be part of this activity at this point in time. Another question here is if we don't convert to fiat, I think this is referring to staking, then are taxes payable on the staking income? And they suspect it is. And then there's a tax liability payable in cash on the higher value of ETH. So Ian, you're kind of leading the charge and helping the auditors, figure this out. We're definitely trailblazers here, sometimes much to our chagrin, and it's frustrating. Can you talk about how we are marking that staking income and how we would think about the tax liabilities tied to it?
Sure. And I think that it's also important to say that there's a period between now and the merge and after the merge, and there's some aspects that will be different. But yes, there is a mismatch where we generate revenue in ETH, but have a tax liability in Canadian dollars because we report there. One of the things that we will probably do going forward after the merge is have a policy of if we sell a proportion of our staked Ether to meet that tax liability. So you can assume that the average tax rate will be about 25% in that range for our revenue. And so it could be that we develop a policy that we liquidate 25% in order to meet our tax obligation.
One kind of final question here, and if anyone has a final question after the final question, please let us know. But the last thing that I guess we'll go to, because it's the last one and the final one in the chat box, they're asking how we're thinking about the model of Ether Capital. And they're saying it doesn't seem quite like it's Berkshire Hathaway, which I'd agree with, because we're not looking to just be a venture investor wrapped in a public structure. And when we think about the discount to NAV, what is the mental model, Ian, that you would describe for Ether Capital, knowing that we hold our biggest asset, our instead of cash, we're holding Ether, so we're tied to that. We're staking it to generate revenues and then using that to generate businesses. What would you compare us to? Is it a crypto mining company? I don't think we would be a crypto mining company. They specifically put Hut 8 here, and I don't think that because our plan is to use those rewards to build other businesses. Ian, how would you answer that? What do you think the right comparison?
Let's suspend ourselves as to the sector that we're in. But mentally, most people are familiar with Canadian banks, and I'm not trying to flatter ourselves with that. But the business model of the banks is that they have a base of capital that is their moat, and that's what we're going to have. We're going to have Ether and be well capitalized, and our intention isn't to sell that, but it is our floor value. What banks are valued at is a multiple of their earnings. And so we are going to build earnings in transition so that the market will look at our business model as a multiple of our earnings, but with a backstop of a strong capital base, net asset value, which could grow with the appreciation of our key asset. So I'll leave Brian to talk about where we position within the digital asset space, but from a business model, expect over the next years, we will transition to a price earnings model so that we hopefully will trade at a premium to net asset value. That is our goal.
And I'm going to throw it to Ashley, but thank everyone for joining us today. We hope to hear from you either direct through a reach out on LinkedIn or email. We're happy to answer any questions about the company, about the Ethereum ecosystem, and look forward to continuing the conversation. And Ashley, anything else you want to add?
No, that's pretty much it. Thank you so much for stopping by, and we'll be sure to publish this to our website afterwards, so you can always play it back, and we'll keep you posted on future webinars that we host. Have a great day.
Bye.
Thanks, everyone.